Should you buy index funds at all-time highs? Because, well, the stock market is hitting new record highs again. And if you've been sitting on the sidelines, you're probably asking yourself, isn't it too late to buy now? Am I just buying at the top? So in this video, we're going to break it all down. First, the data on how markets behave after all-time highs. Then second, why cash looks attractive right now and why many investors are holding back. And finally, what should you be doing now? That's it. By the end, you'll know whether buying index funds at the very top is a terrible idea or one of the smartest long-term moves you can make. And if you like my content, subscribe, it's free, and you encourage me to continue. The stock market is back at all-time highs. And for most people, that feels like a warning sign, like we're standing right on the edge of a cliff. And it makes sense because finance bros, myself included, always preach paying attention to opportunities to buy at a good price. But here's the thing, that logic works better for stock pickers than for people investing in broad index funds. For a market tracking fund, waiting for the perfect entry usually does more harm than good, because in reality, record highs are not rare events. They happen far more often than people think. Since 1926, the S&P 500 has spent about 30% of all months at an all-time high. What feels like rare air is actually just the market doing what it's supposed to do, climb higher over the long run. And the data is clear. Buying at the top hasn't punished investors. When people bought the S&P 500 at record highs, they earned an average return of 10.3% over the following year. That's actually better than the 8.6% average when buying at other times. Even if your timing is terrible, the long-term result still works out. Researchers tested what happens if you always buy at the worst possible moment at annual or all-time peaks. And you'd still have earned around 7% per year over 20 years. That's only about 1 percentage point less than the perfect timer who bought at every market low. The difference isn't timing, it's staying invested. And here's the kicker. Avoiding the market at all-time highs actually destroys wealth. Schroders ran the numbers going all the way back to 1926. If you had simply invested $100 in the US stock market and left it untouched, by the end of 2024, it would have grown to about $103,294 in inflation-adjusted terms, a 7.3% annual return. But if instead you had followed a play-it-safe strategy, switching out of stocks into cash for the next month every time the market hit an all-time high, that same $100 would be worth just $9,922 today. Why? Because over the long run, even small differences in annual returns compound massively. Staying invested produced 7.3% per year, while the sell at highs approach only managed 4.8%. That gap compounds over decades until the difference is life-changing. Selling stocks whenever the market was at an all-time high would have destroyed 90% of your wealth in the very long run. Now let's add some recent context. Just 68 trading days ago, back in April, the market was down nearly 16% for the year and almost 20% from its highs. Recession odds, according to prediction markets, spiked from 20% to 70%. The consensus was a downturn was inevitable. But what happened? Stocks rallied 26% in just 3 months, blasting to new all-time highs. That kind of surge has only happened 5 other times in the last 70 years, in 1975, 1982, 1999, 2009, and 2020. And every single time, the market was higher 3, 6, and 12 months later with an average 1-year gain of 21%. Why? Often it's simpler than people think. Consumers keep spending, businesses keep earning, and the economy proves stronger than the headlines suggest. And that's the point. Markets don't hit all-time highs by accident. They usually reflect that things are, in fact, going pretty well. And since 1989, money invested at all-time highs has actually outperformed money invested on an average day. So if you're worried that you missed it, history says otherwise. New highs aren't the end of the story, they're just milestones on the way to the next one. So why cash looks attractive right now, and why are many good investors holding back? When you see headlines about big investors or billionaires sitting on mountains of cash, remember, they are not the average investor. Take Warren Buffett as the perfect example. Right now, Berkshire Hathaway is holding over $200 billion in cash and short-term treasuries. But does that mean Buffett thinks cash is the best long-term investment? Not at all. Buffett himself has said countless times that cash is a terrible long-term asset because it loses value to inflation. So why does he hold it? Because he's waiting for opportunities that almost nobody else can access. When Buffett deploys billions, he often negotiates sweetheart deals, preferred shares, or gets warrants that you and I could never get as retail investors. In 2008, during the financial crisis, he invested in Goldman Sachs and Bank of America with terms so favorable they practically guaranteed outsized returns. That's not about timing the market like a normal investor. That's about leverage, size, and reputation. And this applies to other legendary investors too. They can afford to sit on cash because they have massive portfolios already compounding in the background, and they have the discipline, connections, and deal flow to strike when nobody else can. They also have time horizons and resources most people don't. For the average investor, the Buffett playbook of holding piles of cash doesn't work the same way. If you tried it, you'd likely miss more upside than you'd ever gain waiting for a crash. Buffett himself has said that the best strategy for 99% of people is simple: buy index funds regularly and never sell. So when you see headlines about Buffett or hedge fund managers keeping billions in cash, don't copy them blindly. These guys beat the market not because they sit out and guess tops and bottoms, but because they play a completely different game than we do. For us, the biggest edge isn't trying to time the next big dip. It's staying invested through all the noise, letting compounding do its job, and avoiding the temptation to think we're smarter than the market. But how about you? What should you be doing now? The answer is simpler than you think. Stay invested and keep adding regularly. If you watched the entire video carefully, you'll already know that this is the answer. And that's not just me saying it. It's the exact philosophy that John Bogle, the founder of Vanguard and the creator of the very first index fund, built his entire career on. Bogle's idea was simple. Instead of trying to beat the market, just own the market at the lowest possible cost. That's why ETFs and index funds exist. They're designed to give you broad exposure, minimal fees, and a way to benefit from compounding without the stress of constant trading or market timing. So when you buy an ETF, you're not trying to be smarter than the market. You're aligning yourself with it. And over decades, that's been one of the most reliable wealth-building strategies ever created. As I've said before, conducting more detailed analyses and dedicating more time to investments makes sense with individual stocks. It doesn't make sense when you're buying the entire market. It's supposed to be hands-off, so you can put your money in and leave it there. You know, it would be a completely different video if you were asking me if it makes sense to sell a specific stock, like Nvidia or Bitcoin, at their all-time highs. Now, if you're wondering how to actually choose the right ETF, the process is more straightforward than people think. Start by looking for one that tracks a broad index like the S&P 500 or the total stock market, because that gives you exposure to hundreds or even thousands of companies at once. Then check the costs, because fees are silent killers. Imagine you invest $10,000 and earn 8% a year for 30 years. With a low-cost ETF charging 0.05% annually, you'd finish with about $99,000. But if you chose an ETF charging 1% in fees, you'd only end up with around $76,000. Same market, same return, but $23,000 gone just because of fees. Scale that up to $100,000 invested, and the difference is $250,000 lost over a lifetime. That's why costs matter more than most people think. Make sure the fund is large and well traded so you can buy and sell easily, and stick with established providers like Vanguard, iShares, or State Street, which run the biggest and most reliable funds in the world. Also look at how dividends are handled, because reinvesting them quietly builds your wealth over time. And finally, don't overcomplicate it. For most investors, the simplest option, a low-cost, broad market ETF, is the one that delivers the best results. So here's the truth. You don't need to panic about record highs. You don't need to wait for dips. And you don't need to copy billionaires who play a completely different game. What you need is consistency, patience, and a vehicle like a broad ETF that quietly compounds for you in the background. Because in the end, buying index funds at all-time highs has never been the mistake people think it is. The real mistake is not being invested at all. That's it, cousins. Stay invested.